So I was looking at the stack of research we have for today, and it is a massive stack. But I kept getting stuck on this one specific phrase that popped up in the notes, the Theta Fuse.
Yeah, it has a bit of an ominous ring to it, doesn't it?
It really does.
Like the title of a sci-fi thriller or something.
Totally. It sounds like something that's about to blow up.
Yeah.
But when you actually dig into the sources, the earnings reports from Microsoft and Meta, the trade data from Caterpillar, the options pricing on oil, it feels like the perfect description for where we are right now.
It really does.
For you listening who might not be trading options every day in your basement, theta is basically time decay, right? It's the ticking clock.
Right. In the options market, Theta measures how much value an option loses as it gets closer to its expiration date. It's the cost of time. It represents the pressure of the clock ticking down against a specific outcome.
And that's the vibe of this entire deep dive.
Yeah.
It feels like we're looking at an economy where the fuse is burning down on several different fronts at the same time. We have this massive disconnect.
A huge disconnect.
It's almost like a split screen. On the left side, you have the titans of industry, the tech giants, throwing around money that makes the GDP of small nations look like, I don't know, pocket change. We are talking about a projected $135 billion.
And that's just Meta. That is
Man.
the number Meta is planning to spend on AI infrastructure in 2026 alone. Just let that sink in for a second.
$135 billion. I tried to visualize that. It's impossible.
It is staggering. To put that in perspective, that is more than the entire gross domestic product of countries like Morocco or Slovakia.
An entire country.
They are spending an entire European country's worth of economic output just to build servers and train models. It's unprecedented.
That is the cloud castle part of our story today. It's this stratospheric spending that feels completely detached from reality.
Yeah.
But then you look at the right side of the screen, the side where regular people actually live.
Right.
And what do you see? You see a report from KFF showing that 2/3 of Americans are now more terrified of their health insurance bills than they are of gas prices, groceries, or housing.
And that's saying something, because none of those things are cheap right now.
Not at all.
That is the great disconnect we are facing right now. We are living in a tale of cloud castles versus kitchen tables. You have these massive capital expenditures, CapEx, at the top of the economic food chain, fueled by this insatiable AI arms race.
And then at the bottom, at the kitchen table level, you have a genuine cost of living crisis that is being driven by policy cliffs and structural inflation. It really feels like two different worlds, doesn't it? And today, we're going to try to bridge that gap. We're going to explore how these two realities are actually colliding. Welcome to the deep dive on the Theta Fuse. Today, we are unpacking this split-screen economy.
We have a lot of ground to cover to make sense of this. We need to look at the AI arms race and why Microsoft stock is actually falling despite beating earnings, which is a fascinating paradox in itself.
Yes, we have to spend time on that. And then there's Meta's $135 billion bet.
And we can't forget the industrial side of things. We're going to look at Caterpillar, the heavy machinery giant. They are sitting right in the middle of this.
Caught between the AI boom-building data centers and the trade war bust, dealing with massive tariffs.
Precisely. And we also have to address the geopolitical heat. The oil markets are flashing red warnings, and traders are loading up on bullish call options because of the tension between the U.S. and Iran. That is where the Theta Fuse is burning the hottest.
And finally, we are going to bring it all back home to that personal impact, the healthcare cliff that just hit millions of Americans. So buckle up, because we are diving deep into the machinery of this economy.
Let's start with the high-stakes poker game happening in Silicon Valley.
Okay, let's unpack this. Because poker game feels like the perfect metaphor here. You have these tech giants, Microsoft, Meta, Google, and they're all sitting at the table shoving chips into the middle. Exactly. But the pile of chips is getting so big, it's starting to scare the people watching the game.
It is historic. We have never, ever seen capital expenditure scaling at this velocity before. And the earnings reports we just saw from Microsoft and Meta paint two very different pictures of how the market is reacting to this spending.
Let's start with Microsoft, ticker MSFT. Because if you just glanced at the headlines or maybe watched a 5-second clip on the news, you'd think they threw a party.
You'd think it was all good news.
On paper, they crushed it, right? They released their Q2 earnings. They beat expectations. Earnings per share came in at $5.16 versus the $3.92 expected.
Which is a significant beat. Usually you beat by a few cents. beating by over $1 is huge. It shows real operational leverage.
And revenue was over $81 billion.
Yeah.
81.27 billion in 3 months. Just a fire hose of cash.
And the big milestone, the one they really wanted to highlight, cloud revenue topped $50 billion for the first time. 51.5 billion, to be exact. That segment alone is bigger than most companies in the S&P 500.
Satya Nadella, the CEO, even came out and said, quote, "We are only at the beginning phases of AI diffusion," which sounds great. It sounds like the rocket ship is just taking off.
It sounds like the ultimate bull case.
But here's the kicker, and this is what I want you to explain to me because it feels so counterintuitive. The stock fell. It dropped nearly 6%, 5.86%. Why does a company beat earnings, hit a $50 billion cloud milestone, and then get punished by the market?
This is the crucial analysis. It pushes back against the simple idea that good news equals stock goes up. In this case, Wall Street looked at the numbers and saw a missed opportunity. It is not a demand problem. It is a supply problem.
A supply problem.
A supply problem. If you dig into the earnings call and the analyst notes, Microsoft explicitly stated that they are facing capacity constraints.
Capacity constraints. So basically, people want to buy their AI services, but Microsoft physically can't sell it to them.
Exactly. Demand is outpacing their ability to supply it. They literally cannot build the data centers fast enough to take people's money. This puts an artificial cap on their revenue growth.
An artificial cap.
And investors see that and get nervous. They see money being left on the table, they're modeling out future growth, and if there's a cap, that model looks less attractive.
That is a wild problem to have. I have too many customers and not enough servers. So it reminds me of, imagine you're running the most popular bakery in town.
Okay, I'm with you.
You have a line of customers wrapping around the block, waving cash in the air, screaming for your sourdough. But you only have 2 ovens. It doesn't matter how many people want your bread, you physically cannot bake it fast enough.
The constraint isn't the customer, the constraint is the oven. That is the perfect analogy. And in Microsoft's case, the ovens are these massive data centers filled with NVIDIA GPUs that consume enough electricity to power a small city. You can't just pop down to Home Depot and buy another one.
No, this isn't a weekend project.
Not at all. This is years of planning, securing land, getting permits, negotiating power contracts with utility companies. It's a massive logistical challenge.
So investors are looking at that line of people outside the bakery and saying, you guys are messing up. You should have built more ovens last year.
Correct. And we actually know exactly how much money is waiting in that line. There is a specific line item in the financial statements that tells us this. It's called RPO.
RPO, remaining performance obligations. I usually gloss over this part of the spreadsheet because it sounds like boring accounting jargon, but you're saying this is actually the most exciting number in the report.
It is the star of the show right now. You shouldn't gloss over it. RPO is essentially the backlog. It represents contracted revenue deals that are signed, sealed, but not yet delivered because the service hasn't been provided yet.
Okay, so it's guaranteed money, just waiting to be collected.
It's as close to guaranteed as you can get. That number for Microsoft hit $625 billion.
Wait, say that again? 625 billion.
With a B. Yes. That is more than $500 billion.
That is just sitting there in a backlog.
It is money waiting to be earned. It's the customers in line with cash in hand. And here is the fascinating detail. 45% of that backlog comes from OpenAI commitments.
So nearly half of that massive pile of money is tied directly to people wanting to use the tech from Sam Altman and the OpenAI team on Microsoft's cloud.
Exactly. The demand is there. It is massive. It is undeniable. But to unlock that revenue, to actually get that cash from the backlog into the bank account, they have to build. They have to build the plumbing.
They have to build the ovens.
And that is why their CapEx hit $37.5 billion in just one quarter.
$37 billion.
Yeah.
In 3 months.
That is up from $22.6 billion the previous year. They are building furiously, they are pouring concrete, securing power grids, and buying every high-end chip they can get their hands on as fast as humanly possible just to catch up to their own order book.
So the stock drop isn't because investors think AI is a bubble.
Oh, it's the opposite.
It's because investors are worried Microsoft can't build the plumbing fast enough to keep the water flowing. They see the demand is so strong that Microsoft is actually fumbling the ball.
Precisely. It is a bottleneck issue. It's an efficiency tax on their growth. Now compare that to Meta, ticker Meta. They also beat earnings, EPS of $8.88 versus $8.16. but their stock climbed.
Yeah, it was up nearly 10% at one point, I think 8%
A
pre-market.
completely different reaction.
Right, and this is despite the fact that their spending guidance is absolutely astronomical. We mentioned it in the intro. They're planning to spend between $115 and $135 billion in 2026.
That is a massive jump from the $72 billion they spent in 2025. They're almost doubling down on their spending.
So why are investors cheering Meta for spending the GDP of Slovakia while they're punishing Microsoft for not building fast enough? Is it just because Meta seems to be ahead of the construction curve?
Partly, but it's also about what that spending represents. For Meta, this spending is seen as an aggressive offensive move. They are not just building capacity, they are buying the ecosystem.
Okay, what do you mean by buying the ecosystem?
Look at the Scale AI purchase.
Oh, yeah, I saw that. They spent $14.3 billion to buy 49% of Scale AI.
And more importantly, they hired the CEO, Alexandra Wang, to run their new superintelligence labs. This is not just a financial investment. This is a talent and infrastructure grab.
So what does Scale AI actually do? Why are they so important?
Scale AI is critical for data labeling and fine-tuning models. It is the grunt work that makes the AI smart. You need humans to tell the model, this is a cat, this is a stop sign, over and over again, millions of times. Scale AI has built the platform to do that at an enormous, scale.
So by buying them, Meta is trying to secure a supply chain advantage. It's
Right.
like Ford buying the rubber plantation to make sure they have tires for their cars.
That is a great analogy. It is vertical integration for the AI age. Zuckerberg is saying, I'm not going to rely on anyone else. I'm going to own the data, I'm going to own the labeling, I'm going to own the chips, and I'm going to own the servers. It's an attempt to control his own destiny.
So investors see that as a power move.
Hmm.
They see it as de-risking the future.
They see it as a credible plan to compete with Google and OpenAI. But it's not all smooth sailing for Meta, is it? I mean, spending $135 billion is a huge risk. If this doesn't pay off, that is a colossal crater in the balance sheet.
For sure, there have to be headwinds.
It is not without risks. Meta has some serious headwinds. We are hearing reports about delays with their next big model, the Llama 4 Behemoth.
Behemoth is a fitting name for something that costs this much.
Indeed, it implies size, power, but also perhaps being slow and unwieldy. And there is a strategic shift happening that is making some developers nervous.
What's that?
CNBC is reporting that Meta might make their next model proprietary.
Whoa, okay. That would be a huge pivot. Remember, Meta has been the champion of open source AI. Llama 3 is out there for anyone to use.
It's the foundation for hundreds, maybe thousands of startups.
If they close the door on Llama 4, that changes the entire landscape for developers who have built their businesses relying on Meta's open code. It's a rug pull.
It would be a massive rug pull. And it signals that Zuckerberg might believe the only way to monetize this massive investment is to control access, just like OpenAI and Google do.
So they might be abandoning the one thing that made them different in this race.
It's a possibility, and they're fighting battles on other fronts, too. I saw that Australia has enacted a social media ban for anyone under 16, and France is thinking about doing the same.
Yeah, the regulatory walls are closing in. It feels like every country is trying to figure out how to put the genie back in the bottle.
Regulatory pressure is mounting globally. And in the U.S., the FTC is appealing the antitrust case regarding the acquisition of Instagram and WhatsApp. That's a ghost from the past that continues to haunt them. So while Meta is sprinting in the AI race, they are dragging a lot of regulatory anchors behind them.
And let's not forget the competition. Google isn't sitting still.
No, they are not. Not by a long shot. Reports suggest Google's Gemini 3 is currently in pole position, outpacing OpenAI's models in a lot of key benchmarks. So Meta is scrambling. That $135 billion isn't just for fun. It is a survival mechanism they have to spend to stay relevant.
So we have Microsoft unable to build fast enough, and Meta spending practically everything they have to catch up. That is the view from the cloud. But as we said earlier, these data centers don't float in the sky.
No, they don't.
They have to be built on the ground. They need steel, they need concrete, and they need a staggering amount of power.
Correct. And that brings us to the industrial bridge. How do we get from the cloud to the dirt?
We get there with Caterpillar. Ticker CHK. Now, usually when I think of Caterpillar, I think of bulldozers and excavators. I think of construction sites and mining operations. But reading their latest earnings report, it sounds like they are turning into an AI play.
In a way, yes. And this connects directly back to Microsoft's oven problem. Data centers don't run on magic. They run on power. Immense amounts of power.
And it has to be reliable power.
It has to be perfectly reliable. Crucially, they need backup power. You cannot have a multi-billion-dollar AI training run fail because the local grid flickered for 2 seconds.
Right, downtime is not an option. If the power cuts for 5 seconds, you might lose weeks of training data, which could be millions of dollars down the drain.
Exactly. Enter Caterpillar's power generation segment. Their earnings report explicitly stated that demand is being sustained by the rapid build-out of data centers. This is boosting demand for their massive industrial backup power generators.
So if Microsoft is building a new data center campus in, say, Arizona,
They're probably on the phone with Caterpillar ordering a fleet of generators to make sure the lights stay on no matter what.
it is a direct correlation.
Absolutely. And that helped Caterpillar's revenue rise to $19.1 billion this quarter. Adjusted profit was up to $5.16 per share. The AI boom is literally keeping their engines running.
But, and there's always a but in this economy, it's not all blue skies for Caterpillar. They are caught in a serious crossfire. While AI is lifting them up, trade policy is pushing them down.
This is the industrial bellwether aspect of Caterpillar. They are a proxy for the global economy. And right now, the global economy is getting hit with tariffs. Caterpillar flagged a massive number for 2026,
What was it?
a $2.6 billion tariff hit.
2.6 billion, that is just gone, poof, because of tariffs.
It is a massive line item to overcome. They said operating profit already fell 9% in the quarter, largely driven by over $1 billion in unfavorable manufacturing costs.
Unfavorable manufacturing costs.
Oh.
That is corporate speak for tariffs made our parts more expensive.
That's exactly what it is. It means the steel they import costs more, the aluminum costs more, the electronic components they import to assemble the machines costs more. It's a tax on their entire supply chain.
So let's hold on a second. This is the perfect illustration of that split screen we talked about in the intro. On one hand, they have the tech demand. That's the bullish story. They are selling generators to Meta and Microsoft.
A huge tailwind.
On the other hand, they have protectionist trade policy. That's the bearish story. They're paying billions in tariffs. They're being pulled in two completely different directions.
That is the complex environment for industrial companies right now. It is a tug of war. Analysts expect their construction segment to grow in 2026 because non-residential activity is stabilizing. But that $2.6 billion tariff bill is a heavy weight. It eats directly into margins.
And let's play that out. If Caterpillar has to pay an extra $2 billion, they don't just eat that loss, right? That's not how business works.
No, they pass it on. They have to. They raise prices on the bulldozers and the generators.
Which means the construction company that's building a new housing development pays more. Which means the tech company building a data center pays more for backup power.
Which means the cost of building a house or a data center goes up, which fuels inflation, which circles back to the consumer.
It's a vicious cycle.
Yeah.
Tariffs are inflationary by nature. And speaking of volatile situations that fuel inflation, we have to talk about energy. Because if tariffs are a slow burn, the oil market right now looks like a powder keg waiting for a match.
It certainly does. We are seeing a significant spike in geopolitical heat. The news broke that President Trump issued a severe warning to Iran. He said, make a nuclear deal or face military strikes.
And the quote that really got everyone's attention, and I think sent a shiver down the spine of the market, was that U.S. ships are ready to act with speed and violence if necessary.
That is very aggressive rhetoric, speed and violence. Markets hate uncertainty, but they react to threats of war very specifically. We saw Brent crude climb above $69 a barrel, the highest since September. West Texas Intermediate is near $64.
But you mentioned something interesting in our pre-show notes. It's not just the spot price of oil that's moving, it's the options market. This is the Theta Fuse angle coming back into play. What are the traders actually doing?
This is where it gets fascinating. This is where you see what the smart money is really thinking. Traders are not just buying oil, they are buying insurance. We are seeing a surge in open interest for bullish call options.
For listeners who might not trade options, break that down. What does that mean? What is a bullish call option in this context?
Think of it as disaster insurance, but in reverse. A call option gives you the right, but not the obligation, to buy oil at a set price in the future. Let's say you buy a call option that lets you buy oil at $70 a barrel next month.
Okay, so you've locked in your price at 70.
Exactly. Now, if a war breaks out in the Middle East and oil goes to $150 a barrel,
You still get to buy it at 70.
You still get to buy at 70. And you make a fortune on the $80 difference. So when we see traders piling into these bullish call options and paying high premiums for them, they are betting that the price is going to skyrocket. They are hedging against a massive supply disruption.
So they're pricing in a war. They are betting that something is going to happen in the Strait of Hormuz.
Exactly. The Strait of Hormuz is the choke point. 1/3 of global oil supply passes through there. It is the jugular vein of the oil market. If a conflict shuts that down, $69 barrel will look incredibly cheap. We could see prices double or even more.
But is this price rise sustainable? Is it based on actual demand? Is the world actually using more oil right now?
And that is the tug of war. The bull case is clearly geopolitical, it's fear. But the bear case is fundamental. If you look at the supply and demand data, the world is actually awash in oil. Supply is swelling from places like Brazil and Guyana. They're pumping more than ever.
So if the war doesn't happen, if the fuse doesn't blow,
Yeah.
if this is all just saber rattling,
If the war doesn't happen, Westpac analysts are warning that prices could slide back into the 50s. The fundamentals are weak. This current price rise is purely a risk premium. It is a fear tax.
a fear tax. That's a good way to put it. So we have a tariff tax on Caterpillar, a fear tax on oil, and an efficiency tax on Microsoft. Seems like everyone is paying extra for something.
And that brings us to the person paying the ultimate price for all of this, the consumer.
Yeah, we've talked about billions in AI, billions in tariffs, and oil wars. But let's be real. What is keeping the average listener up at night? It's probably not whether Llama 4 is proprietary or open source.
No, it is the doctor's bill. It's the health insurance premium.
Let's look at this KFF report, because the data is stark. 2/3 of Americans worry more about healthcare costs than they do about gas, groceries, utilities, or housing.
Think about that. More than housing, more than food. That tells you everything you need to know about where the real financial pain is.
It highlights just how broken the healthcare pricing structure has become. Affordability is the buzzword politicians love to use, but the reality on the ground is harsh. And we just went off a cliff on January 1st, 2026.
We did.
The expiration of the ACA subsidies. This was the Obamacare support that kept premiums lower for millions of people. It expired a few weeks ago. What happened?
The consequences were immediate and brutal. ACA premiums increased nearly 22% for 2026.
22%.
Yeah.
Imagine if your rent went up 22% overnight, or your mortgage. That destroys a household budget.
It completely alters the household balance sheet. And for many, it's not just about paying more, it's about losing access entirely. The Urban Institute estimates that 7.3 million people will lose their ACA coverage because of this expiration.
7.3 million. And where do those people go? Do they find other insurance?
Some might find other plans, maybe through an employer if they're lucky, but the report estimates that 4.8 million of them will become completely uninsured.
4.8 million people. To put that in perspective, that is roughly the population of Ireland, just suddenly, in the span of a few weeks, without health insurance.
That is the human element we cannot ignore. These are people who are one accident, one diagnosis, one bad day away from bankruptcy. That is a massive economic shock to the system at a personal level.
And the policy response to this has been, well, it's been controversial. President Trump has proposed the Great Healthcare Plan. Right? I read about this. The idea is to move away from subsidizing the coverage directly and instead give money directly to Americans to buy care, like a supercharged health savings account.
Essentially, yes. The philosophy is to shift the buying power to the consumer. The argument from the proponents is that if people control the money, they become shoppers, and that competition will drive prices down.
In theory.
In theory. But critics argue that the math doesn't work for lower income or sicker individuals. They argue it leaves many with less to put into a health savings account than the value of the subsidy they lost.
So you might get some cash, but it's not enough to actually buy the insurance policy you used to have, especially if it's gone up by 22%.
Exactly. And the public sentiment is incredibly divided on this. It's a political football.
Of course.
Completely split. According to the polling, 89% of Democrats disagree with cutting the subsidies, but nearly 2/3 of Republicans and MAGA supporters champion the move.
But regardless of your politics, whether you think the plan is genius or disaster, if you're sitting at the kitchen table paying bills today, right now, the economic reality is that the cost burden has shifted onto your balance sheet.
Exactly. The ideology doesn't pay the bill, the money in the bank account does. And it's not just the ACA. We need to be clear about that. Private insurance, the kind you get from your employer, is also up 6% over the last 3 years. This is a structural inflation problem. It is eating away at disposable income for everyone.
So let's try to tie this all together. Because we started with a split screen, we started with a Theta Fuse.
We did, and I think the picture is clearer now. We have an economy running at two speeds. Speed one is this hyper-acceleration in AI. Meta and Microsoft are spending historic amounts of money, hundreds of billions, to build the future. This is driving demand for energy and industrials like Caterpillar.
That's the cloud castles part. The rocket ship. It's exciting, it's innovative, it feels like progress.
Right. But speed two is the drag. The drag of tariffs costing Caterpillar $2.6 billion. The drag of geopolitical risk adding a fear premium to oil prices. And the crushing weight of healthcare costs on the consumer, leaving 4.8 million people uninsured and millions more paying higher premiums.
It feels like we are trying to launch a rocket while dragging a giant anchor.
That is a very apt visual. We are applying maximum thrust and maximum drag at the same time, and it's not clear which force is going to win.
So here is the final question I want to leave you with today. Can the AI boom generate enough economic velocity, enough productivity, enough new wealth to outrun the rising cost of living, the tariffs, and the geopolitical instability?
That is the trillion-dollar question.
Or are we just building $135 billion data centers in an economy where the average person can't afford to see a doctor?
That is the tension. That is the Theta Fuse. If AI delivers on its promise of radical efficiency, maybe it lowers costs across the board eventually. Maybe it helps design cheaper drugs and makes healthcare more efficient. But that's a long way off. In the short term, the friction is incredibly high. I would encourage everyone listening to look at their own portfolios and check their insurance policies.
Definitely check the insurance policy and maybe keep an eye on those oil options too.
Always watch the options. That's where the smart money tells you what they are really afraid of. The fuse is burning.
Thank you for listening to this deep dive. It's a complicated world out there, but we hope we made the picture a little clearer for you today. We'll see you on the next one.
Stay curious.